John,
Yeah,
I have a product for you. I have a method for you. If you'd like to buy in, are you ready? I could cut
yeah.
your I could cut your commute getting to work in half every day.
Okay, nice.
So I can make it an hour drive for you. Are you interested?
So far, yeah.
All right, awesome. So this is how it's going to work. You're going to pay me, and I'll teach you the system. But really what you do is simply this. You just drive 130 miles an hour when you get on the freeway.
Nah,
Why not?
well idea. That increases my chance for accidents, thus death. There'll
But
be
why
no
not?
job for me to
But you'll get there in an hour. It works. I did it. I did it the other day. I went Long Beach to LA, hour, 130 the whole way. It was awesome.
Our two outcomes aren't guaranteed to be exactly the same.
Still pretty easy. It's 130. So
And
you
it increases my risk across the board too. I can get more speeding tickets. I could die.
You
Bad all
can't drive
around.
that fast in traffic.
Oh yeah, you can.
just go on the shoulder.
But
130.
Josh did it.
Done that? Well,
Absolutely not. I think that's a
there
horrible
you go.
idea.
That's the point they're trying to prove here is that just because somebody did something extremely risky and dangerous does not mean that it's a proven way to say, hey, this is how you beat the stock market. This is me saying, hey, this is how you beat traffic. You just drive 130 and bulldoze everything out of your way and floor it and go on the shoulder. That's it. As you said, not only could you risk your chances of getting an accident and dying, but also getting a ticket, random fees, and other stuff that could ultimately just slow you down. So think about that. It's exactly the same here with the stock market and going about trading and investment. And for you guys even just building wealth and looking to use the stock market and real estate to build wealth, hopefully you guys have your, again, your vision fixed on that longer term goal. And again, those three factors of investing. Investments by Benjamin Graham are just so important because that's what really helps you make that differentiation, if that makes sense. So there you go. And, be careful of what you guys see on the internet and what you watch. And when you see people saying, oh, yeah, this is how I did it, this is how I did it, it worked, you got to kind of look into what is this method? Is it I'm going to go drive extremely fast and do extremely risky stuff? Because if that's the case, that's not really strategy and approach. If it's real, it should offer an adequate return, right? Adequate return. It should be looked into, and then the business should be, should be looked into, and should be deliberately. You should protect your losses, diversify your money, not put too much in, scale in, and that's what I was going to say. That's how you could. That's a way where you could deliberately protect your losses. Stuff like scaling in. Do you guys remember what scaling in is?
Mm-hmm.
What is scaling in?
Just start with a smaller position, test your theory. It starts working for you, then you can increase your investment.
Exactly.
Slowly increase investments.
Slowly increasing investments and also selling. So when you're looking to buy or sell a stock, you want to slowly purchase and sell. A big mistake that people often make is they want to buy an option, they want to buy a stock, and they buy it all at once. They want to spend $500, boom, they spend $500. That's not always the best approach because, again, the stock market's always moving, especially when it's very volatile like this. What you want to do, let's say for an option, let's say you wanted to buy this SPY contract. Let's say I wanted to short the market coming into the rate hike for January. Let's say I want to go back this far, right? And I want to spend $200 on puts. So these are out of the money. All of them, I'm probably going to be playing something out of the money, but let's say I want to spend $200. If I bought these for $50, let's say, 185s. I know that's a crazy low number. And again, I'm just going through to give you guys a quick example. But if I bought 4 of these, that would be $200, right? Let's say that's the max I wanted to spend. So what I could do now, instead of buying now this contract, instead of buying 4 of them now, spending $200, and then if the market goes up, or even if the market stays the same and time goes on and the market's volatile, these will decay and you'll lose your value, and boom, the contract goes to zero. What you could do instead is scale in, and that would mean by purchasing, you could buy one today, buy one the next week, and if they're the same price or cheaper, hopefully if it's cheaper, you could even possibly get more contracts, or spend the same $200 and get the same contract, or even get now a better strike price. So then that way it allows you to place your order in segments. It's like sending in your troops in blocks and groups to get your order in. So never buy all of your stocks at once. You go in groups at a time. The best way is, I think of it as a pyramid. It's like building a pyramid. You want to buy in little blocks, and then as you move up, and then keep adding to it to overall, because it will lower your price. Because imagine, as the prices on some other assets, like this one's probably not going to fluctuate a lot, but especially even on day trades, surprisingly, especially if something's moving against you, by scaling in, it could limit your gains sometimes, but it will also limit your losses. But it gives you flexibility to move around. Really, this is that cost price averaging. John keeps saying. Didn't you say you're going to be a king of that, John? Dollar cost average.
Dollar cost average.
Yeah.
Oh yeah, man. I'm a huge fan of that.
There you go. So that's scaling in on the buy side. On the sell side, it's simple as when a stock is going up, let's say you have multiple options, multiple shares, the stock's hitting a new high. Instead of selling all of it at once, sell a third, then sell the other third, and then sell the other third. Sell it at 3 different times throughout the day, 3 different price points, 2 different price points, as many as you want. But again, give yourself time. Remember, you will spend an extra $5-10 in commission, and now you have to factor that in, because if you're just trying to squeeze out an extra $10-20, think about how realistic it will be and how that factors in with commissions. But on some bigger trades, or if you're trying to take profits and you're really trying to exit, sometimes it's worth it to spend that extra $5 or $10 commission. So I'm going to be opposed to using that.